It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
If you're nearing retirement and still in a relatively moderate tax bracket, it might be the perfect time to supercharge your Roth IRA savings. In this episode of Wise Money, we're diving deep into a real-life question from a listener who is looking for creative ways to maximize their Roth savings in the final years of his career. And we'll walk through the pros and cons, the tax considerations, contribution limits, and strategies to help you make the most of these final working years as you build tax diversification into your investment strategy.
All right, yep, we're hitting all that sort of stuff. Big idea is right before you step across that line, that finish line into retirement, how do you get as much of your wealth growing tax-free as possible? We're going to share some creative ways. If you have a question for us, we'd love to hear from you and need some help. We're here for you as well. You can give us a call or send us a text, 574-222-2000. That's 574-222-2000. Online, you can find us at wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, so like Kevin said, we're kicking off today's program with a question from a fan of the show. It's a long one. It's just fantastic, though, and a lot of pieces we're going to break apart and help you apply to your financial situation. So here's the strategy. I have access to both a Roth 403B and a Roth 457 through work. I currently max out my Roth 403B and my Roth IRA. I'm about 4 years away from retirement, currently 56 years old, married, filing jointly, and we're near the top of the 22% tax bracket. I'm considering using funds from a taxable brokerage account, so a non-IRA, non-retirement account, and those would be taxed at a 15% long-term cap gain to help cover my living expenses so that I can contribute more to my Roth 457, potentially maxing out both Roth 403B and Roth 457. I've got about $25,000 of headroom before hitting the combined employer and employee contribution limit. Does it make financial sense to draw from taxable assets now to maximize my Roth contributions while I'm in a moderate tax bracket? It's a long one, but my goodness, that's fantastic question. We're going to get into those different layers, but again, with the overarching approach of how do you get as much money growing tax-free for your retirement as possible. 403B, 457. Let's start there. Let's level set. What are those? Most people familiar with 401k. What's 403B? What's 457?
Well, I think of a 403B as really almost identical to a 401k. They've gotten more and more similar to each other throughout our working careers. Yeah. They used to be very different from one another, had different rules, and they've gotten more and more alignment. But if you think of a 403B, almost like that 401k that maybe you have in your work situation, if you had been working for a nonprofit organization, maybe a school, a church, a hospital, that sort of thing, then most likely they didn't put a 401k in place. They instead created a 403b for you. So it's a retirement account that you can contribute to right out of your paycheck, and your employer might have a company match or an employer match that goes into that account as well. And I don't know. It's a fantastic tool. Same limits, same amount that you can contribute as a 401k. So I like to just explain it as a 401k for people who work in the nonprofit space.
Yeah, there's some unique differences, and with 401ks for profit, you typically have one provider. With 403bs, it used to be that you could just, you'd go to a school and they'd have 6 different companies that were offering 403bs.
That's right.
And it made things a lot more complicated. Kevin, how would you describe a 457?
Well, it's another type of retirement plan. So as we're talking about 401k, 403b, 457, these are just sections of the tax code. So you say, well, what do these letters and numbers mean? It's just a section of the tax code. So in particular, the 457 is a deferred compensation plan that it has to be a governmental entity or a tax-exempt organization under the 501c. And again,
A lot of hospitals will
Yeah.
have these in place, especially for like upper managers or the really highly compensated doctors, that sort of thing.
State, local governments, credit unions, I mean, go on down the line. So there are a lot of different use cases where this is used, and it would be almost like a second retirement plan, if you will.
Yeah. What if you think back on your career, all the times that you've seen a 457 plan? What's the profile of the type of person that you would typically see? It's all those groups that you just said.
Yes, I would say predominantly the state and local workers, but I work with clients.
In hospitals.
Yeah, hospitals were the one that are at the top of my list probably.
Yeah.
And you're right. It's a second retirement plan. It sits on top of the 403B, and it sounds like the question we get to hit today is one of those situations where they've got more than one plan in place and available.
And the advantage to all these different types of plans is the tax deferred growth that you can have. So it can be pre-tax, and again, depending on the plan, because the plan document dictates what you are and are not allowed to do. But the big benefit is, for most people, the way that they have savings and investments is because it's automated and because it's easy. That's what these plans allow for, and these plans allow for tax deferral. So for most people, this is the most powerful wealth building tool they'll ever have access to.
403Bs and 457s are typically pre-tax. They can be Roth as well, if allowed, and that's the question here today. You might also hear about a 401A. That's typically an employer match for those nonprofits. You might even have a supplemental retirement account. We're bringing all this up, I mean, just to hit an action item right out of the gate. Find out if your plan, if your company, if your employer offers any additional contribution, defined contribution plans, is what they're called. Sorry, beyond what the normal is, right? Beyond just a 403B, 401k. Ask and find out if there are any other creative plans available to you.
Especially as you get late in your working career, right? I mean, if you have a plan available, you're maxing out your 403B. A lot of people are not able to then contribute even more just from a cash flow standpoint.
Right.
But who knows? Maybe your family situation, you have two incomes, or maybe you've received some extra dollars in an inheritance or something like that. If you have a way to take advantage of more tax shelters than what you typically have early on, I agree. Check out what your options are with your HR department.
Okay, so let's start getting into the question then, and the first component of it is, listen, I've got some dollars in a taxable brokerage account. So not in an IRA, not in a 401k, just a side account, whether he saved up in addition to or above and beyond what he was contributing to the Roth IRA or whatever, or these dollars were inherited or they came from a different source. There's some dollars that's growing not in a tax sheltered account. Is it a good idea to reduce, to basically contribute even more out of your paycheck than you can really afford? So now your paycheck is even lower than what you need it to be for lifestyle, and play the shell game and pull dollars out of that taxable account to live off of. Guys, what are your thoughts?
I love the idea that this question's even coming up. It's a creative way to get the cash that you need in order to max out these accounts. And again, the strategy being maybe to contribute directly out of your paycheck and take your net paycheck, the amount deposited into your bank account, down to a level that you wouldn't be able to live at. That might be hard, but that's what it would take sometimes in order to max out two retirement plans like this. And so how do you supplement your living expenses? Yeah, by tapping into other resources. And I like how you pointed out that it could be something that you saved up intentionally for, a plan like this. Or the more common situation, which you also mentioned there, Mike, was inheritance.
Yeah.
You may have some dollars available. This is where the creativity comes into play, and this is exactly the type of question that you would want to be working through with your certified financial planner.
Yeah, I think in terms of your financial life as a pair of cargo pants, and you got one pair of pants and a bunch of different pockets. And a lot of times people think, well, wait a minute, if I've got money in this pocket, I can't take it out of this pocket. I have to take it out of the pocket that I'm used to taking it out of. And you say, no. don't take it out of that pocket, take it out of the other one.
Yeah. So we do this strategy all the time. I absolutely love the question, and it makes a ton of sense. Now, there are some things that you need to be aware of. We're going to pick this back up because there's a huge potential risk that you need to be aware of before you embark on this strategy. We got a hack to help you with it. And then we got to wrestle with the taxes because you might be paying some capital gains taxes when you do that. Does that make sense? And what would the wise thing to do? So we got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning. Also on podcasts at the same time as well, but also on a couple local radio stations at the same time, which is why the content's structured the way that it is, broken up with breaks and commercial breaks, all that sort of stuff. But if you're looking for more direct content in shorter form, maybe we've got all that for you right here on this channel as well. Next Wise Step videos air every single day of the work week, helping you take your next wise step in your financial life. So if that sounds like what you're looking for, we're here to help. Make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, leave questions here as well. Lots of folks engage with us here and create valuable questions that we hit on the show. So thank you very much. All right, Kevin, with all of our bantering before, I think you're noticing what I'm noticing.
Which
that arm, we're trying to have a conversation at a coffee shop, and this arm is right in your eye path to me.
Right.
This one. And so it's like, well, should I put my head up? Should I put it down?
Yeah, I can do it.
Yeah.
And then just turn it.
Watch this. Just do it over here.
Yeah.
Watch this. Okay, they don't call me the studio whisperer for nothing.
There you go. And now that's level with your...
I wonder if that's a little too far, but...
Okay.
Can you guys see each
You're
other
going to move
and
out
talk?
of the...
Well, if I do,
range, but-
I hopefully...
All right, I want to talk pros and cons with this strategy.
But I want to know, have we said or are we planning to say why you would do this? Because there's really
Nope. Say it on the show.
well,
Come on.
I know, but I'm going to say it on the show, and then you're going to give me the old Bernard crazy eye that says that's point number 4, you numbskull. Didn't you look at the agenda? Okay.
That's the Bernard paradox right there. That's really the crazy eye.
I'm telling you.
That's right.
I'm telling you,
I like
Coach Bernard. I feel like I feel like I should just either start doing push-ups right now or go run some sprints.
Yeah. That you hit a nerve right there. We had Coach Bernard came out with fangs.
Yikes.
Oh, jeez.
Coach Bernard needs vacation.
One of the kids, yeah, I thought they were going to puke, and the dad told me one of the kids had an asthma attack after.
Yikes.
Yeah, so, but they got off easy, by the way.
Really?
Yeah. All right, here we go. All right, so yes, let's talk about why. So here we go.
This is money.
Would it ever make sense to draw down other assets that maybe you've set aside for a specific purpose for your financial life? Draw those down so that you can contribute even more out of your paycheck to your retirement plans at work. What are the pros and cons? What do you need to look out for? We're helping with that right now. This is Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Have a fantastic question from a fan of the show. And the emphasis is I've got some other assets, a taxable brokerage account. I'm thinking of drawing that down to supplement my income and having more of my paycheck, sheltering more of my paycheck into a Roth 457. Is that a good idea? We do this all the time. Let me tell you one huge con. Let me start with the tip, and then I'll tell you what it solves. You're going to want to do that math and calculate, well, by maxing out your 457, what is that going to reduce your take-home by? Whatever that math is, and just round it off, but then set up an automatic withdrawal from that taxable brokerage account. Because if you don't set it up automatically, all of a sudden, there will be the temptation to do one of two things. I don't want to draw from this taxable account, so I'll just figure it out. And then pretty soon, you said you're married filing jointly, so pretty soon you're arguing with your spouse about
Why is the budget so
can we
tight?
afford to do this? Why'd you just freak out? It's just strawberries, blah blah blah. It's never happened to me. Or the other side of the pendulum is, or spectrum is, that you start saying, well, let's draw a little bit more from that brokerage account. Let's draw a little bit more. Oh, this came up as well. Let's draw more. And all of a sudden, you didn't play the shell game. You actually just threw your financial life off balance there. So do the calculus. What's your reduction in take home going to be, and then set up an automatic withdrawal from that taxable brokerage account.
So replace that part of the paycheck with an automatic amount, and so cash flow feels identical to what it would have.
It's just that's the cargo pant analogy, Kevin. And people feel like they can't do it. I just have to continue to touch the money in the pocket that I'm used to because they don't want to mess anything up. That's a way to not mess it up.
Yeah.
Anyway. Okay, can I hit one other, Kevin, before you get into
sure. Go ahead, Mike.
why you would and why you wouldn't? I mean, the other is sort of in the question is, well, if I draw this money out of the taxable account, I'm going to have to pay capital gains, 15% long-term capital gains.
Right.
Does it make sense to do? Yes. We get this question all the time, right before retirement. Well, if I put money in my Roth, I might not touch it. You can take the money out the next day. And guess what? If you take out the earnings, it's tax-free as long as you've had a Roth for 5 years. So the capital gains taxes on that taxable account, that brokerage account, they're going to be there. Whether you start drawing the money out now or out there in the future, they're going to be there unless you can find a way to be in the 0% cap gain bracket. But I'd rather have that money in the 0% bracket, i.e. the Roth.
The Roth. Yep.
Yeah, and so this is something that it's kind of hard to come up with this type of creativity in your own situation. And I've been able to serve clients and just show them, hey, you've got this money sitting over here. It's non-qualified money, non-retirement plan money. And if you disturb it in any way, shape, or form, it's going to kick off capital gains. So the question is, do I want to pay capital gains or not? But the other question is, do I want to pay a little bit of capital gains or a lot of bit of capital gains? Because the longer it sits and grows, with compound interest being the eighth wonder of the world, the capital gains that you owe on those dollars are only going to grow. So the question that you need to ask is, in a perfect world, if I could put $31,000 into a 457 plan, and I had $31,000 in my brokerage account, would I be better off selling that, paying whatever taxes were due, and putting it into the 457 Roth, the Roth side of the 457? And I would make a case that, yes, if you can convert non-qualified money to Roth money, you are money ahead, especially if you have time on your side. So this is where you say the question, why would I even do this if it's going to cause some complications in my financial life, and life's already complicated enough, I don't want this. Don't do this to me. I would say, well, if you can just hang in there a little bit and deal with the complexity, it will pay off in spades for you, because now you have money that was growing and generating a higher capital gains tax bill that is going to be growing tax-free forever.
Yeah. And I agree completely that to the extent that you can get more money into a tax-free shelter, man, that's just powerful for your financial life. If I can issue just a small warning, though, I think it's important that this decision is made in the context of your comprehensive financial plan, and specifically a tax projection. Because what you don't want to do is hear three knuckleheads on a Saturday morning saying, yeah, more money into a Roth is always a good idea. Well, if it's coming at the cost of, yes, generating some additional income, what if your income is already up flirting with a threshold that you now cross because you've added additional capital gain income to your tax return? And now, 2 years later, maybe you're paying the cost in the form of higher Medicare premiums or Part D premiums, that sort of thing. So I'm referring to IRMA and paying attention to the fact that, you have a lot of moving parts in your financial life, and they often show up on the tax return that can reveal to you whether or not it was a good idea or a great idea. But just be careful that you don't have some unintended consequences by cranking up the income just a little too far, and you pay the price for that 2 years down the road.
That's a fantastic warning. And I was going to go there as well. In this specific situation, from the question, is 56, so Irma's still a ways off.
Sure.
But what could be a new tax created by this strategy if you don't do it with a tax projection? Net investment income tax. Net investment income tax. You said that you were near the top of the 22% tax bracket here in 2025, married to filing jointly. The top of the 22% tax bracket is basically 206, almost 207. You get to that net investment income tax at what, 250? Mm-hmm. And so depending on how much capital gain or dividend income or whatever else is there on your tax return, you might trigger net investment income tax that you wouldn't otherwise pay if you're a little bit more sensitive to, all right, how much capital gains do I realize in any given year?
But this is why you want to do tax planning, because I do think there should be the consideration, because you say, what do I love about the Roth IRA? That money goes in, after-tax money goes in, and it grows tax-free forever. That's incredible. But you do have to consider, with your capital gains situation, is it possible that I would get that money out of my non-qualified account someday and pay zero capital gains?
Okay, so here's the thing. We mentioned that, but Josh, so the tax projection, we use the phrase multi-year tax projection quite a bit. So in this scenario, you're 56, you're looking to retire at 60. That's before Social Security starts. What are you going to use for income during that time? If, I don't know how large this taxable brokerage account is, what if that taxable brokerage account was your bridge to Social Security and that's all you lived on? And there was no earned income, there was no Social Security income, there was no pension income, although 403B, 457, it's possible you work for a government entity and there could be a pension. So, but could you structure those first few years of your retirement such that you're in a very, very low tax bracket and therefore pull some of these dollars out at 0% capital gains? Maybe you optimize for that. Build that strategy so you get the best of both worlds, drawing down some of the assets, maybe the ones with the lowest capital gain risk, to max out that Roth, but then also keep the highly appreciated assets for those first couple years of retirement and pay 0% federal cap gains on those.
Love it. That is the situation where your tax planning has to get married with your retirement forecast, because you have to be thinking down the road on what am I going to be spending down in each of the years of retirement. And I love your analogy, though, of allowing the non-qualified dollars, these taxable accounts, to be a bridge that gets you to Social Security.
And if you're listening and you're saying, wait a minute, how in the world do I have how am I in the 0% capital gains tax bracket? It's possible.
Yeah. That is at odds with another strategy of trying to get as much money, as much of your wealth growing tax-free as possible. So this is where you got to work with your CFP, working on all 6 areas of your financial life to see what makes sense. We'll tell you what that risk is, and then what are some other ways to get more money into the Roth at the end of your career. That more coming up on the Wise Money Show with Korhorn Financial Group. I might have just broke the sound barrier. That was fast. And
you're getting up again?
Yeah, for all this tinkering.
Josh,
you messed it up.
Yeah, Josh is coming in hot this morning.
You were down there with your feet, and you're like, my volume's not quite right, and then you messed with mine.
Oh my!
So I know.
Did you dial my mic down partway through this show?
In the first segment.
Yeah. Okay.
All right. Here we go. You can't taste peanut butter or smell most things, but you can tell when she turns your volume down a little bit.
Oh, the old Princess and the Pea, if you will.
All right, here we go.
You guys know that story?
Yeah. But
do you know how many
you have a
people
different
don't know the
version?
story? No.
Oh.
But a lot of the youngsters don't know that story.
Okay, so we're going to put the wraps on this question, and then it's going to lead us into all right, so what are your tax-free accounts that you could fund. So we'll go basic, Roth IRA, Roth 401k, 403b, that sort of thing. And then backdoor Roth, mega backdoor Roth, HSA 529 plan. Sorry, I just spoiled the whole show for you. Stay with us, though, because there might be another one. All right, here we go. So halfway through. If the name of the game near the end of your career is you've built up wealth and you've sacrificed, you've worked hard, and you're looking at your nest egg, if the name of the game is how do you get as much of that wealth growing tax-free as possible, what are your options? Creatively, what should you be doing working with your CFP? We're going to help share those ideas. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Rate the program there. Subscribe to it as well so you don't miss an episode. We appreciate that. Wrapping up, answering a question from a fan of the show who's got 4 more years before he retires. And he's looking at, hey, how do I get as much money, as much of my wealth as I possibly can, growing tax-free? I mean, at 56, these dollars have another 30 to 40 years to grow tax-free in his lifetime, plus another 10 by his heirs. That's a long time. One of the whys, Kevin, is you've got a lot of time. Let's get as much money as possible growing in that Roth. And so the question is, should he draw down some taxable assets, live on those, and have more of his paycheck going to the 403b? The answer is yes, like a big, big yes, but make sure that you're working with your CFP, looking at all 6 areas of your financial life, especially building out that multi-year tax projection so that you see how far you should go, whether there's a strategy where you should do this a little bit, but then pull some of those dollars out of the taxable account at the 0% tax bracket in the early years of retirement. But here's the other risk. In those early years of retirement, one of the other strategies, if you're going to try and get as much of your money growing tax-free as possible, is Roth conversion. And when you're trying to keep yourself in a low tax bracket to be 0% capital gain, that's at odds with doing Roth conversions. You know, it's also at odds with trying to keep your taxable income low for maximizing premium tax credits. For your health insurance. So I don't know if you've got retiree health insurance or whatnot, but this is the thing. Like, this is where paying the least amount of tax over your lifetime and needing to look at all 6 areas of your financial life, that's really going to inform the strategy here. Because you could...
Yeah, I think the risk that I think of as well, because I'm close enough in age to this person to be connected with the fact that 56 is very young. Incredibly young. And if you said 30 to 40 years, I would agree with that. But here's the risk, that it's not. That it's 6 or 7 years.
Yep.
And if you spent the last 6 or 7 years of your life constricting cash flow for some future possible event, you might have a regret or two.
That's where it's balanced, right?
Yes,
Yeah,
that is where balance needs to come in. But because if you needed to, if it was required for you to achieve your financial goals and to have a dignified retirement with financial freedom and independence, then it might make sense to have that sacrifice. But if you didn't need that sacrifice and you were just doing it because you wanted to geek out on the tax planning, or you just heard about an idea and it sounded really good, so you said, well, let me do that idea, I would be careful. So that is one of the risks, is that you create imbalance. This is why people need to work with certified financial planners who do financial planning.
I feel like the more common imbalance, it would be people who are thinking about the here and then and the now, and not thinking down the road to, the 70-year-old them. And I don't know, Kevin, if you were the one that shared this with me or what, but I've often reminded clients that part of the reason that you have a certified financial planner in your life is to be advocating for that future version of you, because you know what your needs are today. You know what all the wants are and all the creative ideas that you could use money for, and you could burn through assets today that really should be preserved for the future and needs that you'll have out there. But that person doesn't have a very loud voice in your life right now. And by going through working with a certified financial planner, doing comprehensive planning, you're amplifying that future voice. And I love the word balance, because you have to live today. You are not guaranteed a tomorrow. But at the same time, there's a very good chance that you're going to have more tomorrows than you even realize you will. And you want to make sure that those are funded as well.
Yeah. We love the question, love the situation. We do this for folks all the time. I'd be remiss if I didn't also mention, Kevin, you said that most people, this creates a little bit of complexity, a little bit of confusion. Most people, you need some sort of external stimulus, someone else looking at your financial life in order to bring this idea to you. How do they do that? Your balance sheet or your net worth. Mm-hmm. If your financial life isn't structured and laid out in a way where you can see all the different pieces, this might be hiding in plain sight, and you just can't see it because these dollars, you're envisioning them somewhere, for a certain purpose, but then you've got your retirement accounts over here. You might not see that they're all sort of part of one big plan. And so work with your CFP to make sure that your balance sheet is up to date, your net worth is up to date, so that it's actionable. Your financial life is actionable. Okay, I am mesmerized by. I'm just going to tell you, and it could be stage of life, it could be client situations I've been a part of. I have no idea. I am absolutely mesmerized and just completely on board with. All right, what are all the strategies that I can implement to have as much wealth growing tax-free as possible? Like, what if that was the name of the game? Yes, in balance, but when you're looking at building wealth, all right, what are my options? And you might, I don't know, as I started thinking about this, you might sort of take it for granted. Because Josh, throughout our entire careers, the Roth was around.
Yeah.
Kevin, it became a thing right at the beginning of yours.
Mm-hmm.
And if you're newer to the retirement savings thing, you might just say, well, Roth is, of course, I'm supposed to have a Roth. The fact that we have an ability to save up money and have it never be taxed again is an unbelievable opportunity. So how do you maximize that? What are your options? It starts with the basics. Roth IRA, Roth 401k, 403b, 457, whatever. How are you using that? What, guys, let's share it. Contribution limits, level set, how do those work, that sort of thing.
Well, I mean, you just rattled off the different Roth types of tools, but the fact that there even is a Roth 401k or Roth 403b or a Roth 457 plan, for goodness sake, some of those have that feature added now. Again, that maybe your memory doesn't go back far enough to realize that that's still relatively new, and it's possible that you're not utilizing it. Yeah. That maybe you kind of locked yourself into a game plan years ago, and you've been doing all traditional contributions to your 401k at work. And it's reducing your income. It's saving you some tax in the year that you contribute, but you have an IOU to the government building up right now. And so to maybe rethink that strategy and start to pivot over to contributions that would be after you've paid your tax, then the contribution goes into a Roth account, as opposed to dumping the money in before any tax is calculated in that year of contribution. That's something to consider. Or even rethinking the way that the existing money that you've already built up is going to be taxed someday. Maybe doing some Roth conversions within your account, even while you're finishing out your working career.
The amazing thing is, depending on your plan, you can do in-plan conversions.
Yeah.
So if you had a 401k or 403b, you can do an in-plan conversion. Again, this is dependent upon your plan document. Is it allowed or not? You can even do that in your 457. Oh. So if you've got a 457 that you've been loading up on, and it's all pre-tax, if you said it makes sense to start paying some of the tax now, you can get that flipped over to the Roth side and let it grow tax-free forever.
Roth, 401k, 403b, all that sort of stuff. Contribution limit this year, 2025, $23,500 is the normal contribution. If you make less than that, you can contribute all of your income into it up to that $23,500. $7,500 is the normal catch-up, the year you turn age 50 and above. But then there's the special catch-up at age, age 60, 61, 62, and 63, you can do up to $11,250. If you do have that 457 plan, there is a wild, really weird special catch-up contribution with 457s where you can contribute up to double the contribution limit each year, as long in the final 3 years before the stated retirement age, normal retirement age within your plan. This is getting super, super complicated. But if you haven't been maxing that 457 in the past, you can basically contribute twice as much in those 3 years right before you retire. But you got to work with your CFP, of course, but then review your plan document to see if that's possible. What are some of the other creative ways to get more of your wealth growing tax-free for your retirement? That and more coming up on the Wise Money Show with Korhorn Financial Group. All right, so creative ways to get money into a Roth. So we mentioned the not creative ways.
Into tax-free accounts, you said.
Yes,
right?
Thank you.
Okay.
Because we're going to add a couple at the end.
Oh, okay.
But so we mentioned contributions. We snuck in conversions.
You had mentioned that you wanted to talk about maybe mega backdoor.
I think we got to at least mention these, and we'll just watch the clock to see how much, because there's a few others that I just thought of as well that we need to hit.
Okay.
So 4-segment, land in the plane, all about what are the normal ways, what are the creative ways to get your wealth growing tax-free.
So this probably is not then going to fit in this segment, but when I was in Africa, one of the pastors told me he was excited because he's 60 this year, so he's doing the extra catch-up, and I was excited because most folks don't know that. Most financial advisors don't know that. So he's getting great financial services help, and
Wonderful.
It's really cool.
Well, I mentioned that special catch-up contribution in the last segment. We probably don't need to dwell on it more because we've got a lot to hit. So, all right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go check it out. Well over 1,500 videos by now. Every episode of the show, but then next Wise Step videos, 8 minutes long, 10 minutes long, all that air all throughout the work week are there as well. So make sure you go to YouTube, search the Wise Money Show, subscribe to it there. Talking about creative ways that you can get as much of your wealth as possible growing tax-free for your financial future. Started with the not really creative ways, and that's just funding the Roth IRA, funding a Roth 401k, work with your CFP, confirm that it makes sense to contribute after tax or Roth compared to pre-tax, but that's kind of the primary way. The secondary we already sort of mentioned as well, and that is looking for opportunities to do a Roth conversion, whether that's within your plan or transferring from a traditional IRA to a Roth IRA. That's a taxable event, so you need to be aware of what the tax consequences are going to be, and you've got to have a strategy for covering those withholdings, covering the taxes, because if you're not yet age 59 and a half and you withhold the taxes, those dollars will be penalized. So work with your CFP, build out that tax strategy. A couple others before we get in, we're kind of building more creativity here. His employer match. Employer match has always been pre-tax. And this has been confusing. If your 401k or whatever has only been Roth, all your contributions have always been Roth, do you have any pre-tax dollars in there? Yeah, probably. If you're getting a company match, it's been pre-tax. Just started recently the ability to say, nope, I actually want my employer match to be to the Roth side of my 401k. Most plans, that's not logistically possible yet, even though it is the law. You could do a Roth conversion and before that does become possible for you, but that's something to consider. And then the other, we've already talked about catch-up contributions and the special catch-up contribution if you're age 60 to 64. Starting in 2026, it's the law. I don't think they're going to delay this again, but if you make over a certain amount, then your catch-up contributions are going to be forced to go into the Roth. Okay, so that's not it's not a choice, but just be aware if you're thinking of how do I get more money into the Roth, and I'm currently doing pre-tax. Just know that if your income is it's above 135,000, I believe, for the previous year with that employer, then the next year your catch-up contributions are going to need to go into the Roth. You won't have a choice.
Man, the rules are just more complicated now, and I don't think that's me just being old. But the complexity that keeps on coming every time Congress adds to the rule book on this is exactly why you have to be working with your certified financial planner on understanding what your options are and how do you max it out yourself.
As soon as I said 135, I was like, that's not right. It's 145,000 with that same employer the previous year. So if you didn't change jobs or whatever. But yeah, Josh, absolutely more complicated. Let's get more complicated. What are some more ways to get to creatively get more of your wealth growing tax-free? Backdoor Roth.
Yeah. So if your income is too high and you're not allowed to contribute directly to the IRA and write off that contribution, or you're not allowed to contribute to a Roth IRA directly, the backdoor method is to make a contribution to a traditional IRA and then convert it. And so it's really just a two-step process that results in the same thing happening. It feels like just a contribution to the Roth, but because of just the technicalities on the rules and the income limits on who can contribute to a Roth, this is something that your certified financial planner can help you orchestrate maybe every single year, but it'd be something that you'd want to take a look at.
Several big mistakes with this. It sounds, I think the secret's out on the backdoor Roth. I think what is still a secret is all of the pitfalls. If you've already got pre-tax IRA dollars somewhere else, if, even just hearing you say that, Josh, you said it correctly, but you said if your income is above certain limits, well, define income. Most people, when you hear, when your income's above, you think my paycheck money, my income. No, it's your total income. So if you're married, yep, your spouse's income. Interest, yep. Dividends, yep. Capital gains, yep. It's all of that. It's modified adjusted gross income is above certain limits. All right, so going further, if the name of the game is get as much of your wealth growing tax-free as possible, mega backdoor Roth IRA. Then it sounds like a movie, like summer thriller. So Megalodon. My kids love, I don't know why, but they're afraid of the ocean, and it's probably because they watch all these scary shark movies. But the mega backdoor Roth, this is where above and beyond your normal contribution limit, so the $23,500 and your catch-up, the normal contribution limit applies to pre-tax or Roth. If your plan allows, not all of them do, if your plan allows, you can actually contribute more than that, above and beyond the $23,500, but it has to be after tax. So not Roth and not pre-tax. It's after tax, meaning you don't get a deduction on your contribution, and the growth on those dollars is going to be taxable out there in the future when you withdraw them. Why would you do this? Well, one, getting more of your dollars growing tax sheltered, but two, if your plan then also allows for in-service withdrawals or in-plan conversions, there is a rule. You are able to take those after-tax dollars that you put in your 401k and transfer them to a Roth IRA. Unbelievable. Mm-hmm. That's where you can do a mega backdoor Roth, because how much can you contribute after tax? Well, again, it's above and beyond your $23,500, but your contribution, $23,500, and your employer match, and anything else that you contribute it can't be more than $70,000 in 2025 plus a catch-up contribution. So you could do another $20,000, $30,000 into this.
And have it land ultimately into that Roth account. And man, I wish every retirement plan had after-tax contributions as an option. But unfortunately, you got to do some digging and confirm whether the rules of your plan even allow for this. But if they do, and you have the cash flow flexibility to be able to pull it off, it is a fantastic way to get major contributions ultimately landing in a Roth account.
So your Roth 401k, your Roth employer plan, because they even have Roth simple IRAs, Roth SEP IRAs, okay? Roth IRA, that's option number 2. The match from your company, having that go Roth. backdoor Roth if your income's too high, mega backdoor Roth if your plan allows. These are all creative ways to get more of your wealth growing tax-free. Now we're going to step off the Roth reservation. Why? Because there's more options for you to build wealth tax-free. Health savings account, HSA.
Yeah, that is a great plan. Now, the thing is, you don't want whoever's managing that, because when I talked to my wife about this idea, she said, so you're telling me I'm taking at that time, I think it was $7,500, a $7,500 pay cut, because what we were doing is the HSA money was going in and it was being used for broken arms and broken legs and all the things that kids do when they're growing up and playing soccer and riding motorcycles and doing what they do. So that you can't constrain your cash flow. But if you can afford to pay your medical expenses out of pocket, you can take the HSA money that you contribute every year and invest it. And if you can systematically do that over time, I mean, we are seeing people with hundreds of thousands of dollars in their HSA accounts. Yeah. It's amazing.
It really is. And we love the HSA because it is like the ultimate tax shelter, right?
Yes.
You get a tax savings on the contribution. It can grow tax-free. Mm-hmm. And then when you pull the money out for even reimbursing medical expenses that happened years in the rearview mirror, if you pull that money out eventually down the road, that comes out tax-free as well. So
right.
What a powerful tool.
And it is confusing because people think I have to match up my medical expenses in my current year with my HSA distributions, and you don't. And that works unlike anything else.
Yep. And then the last one is the Roth IRA, but for education. That's a 529 plan. Works just like a Roth. You don't get a federal tax benefit on the way in. You could get a state tax benefit though. All the activity, the investment, dividends, capital gains, all that sheltered from tax. And then when you withdraw the dollars for qualified educational expenses, the growth comes out tax-free. And you might be thinking, we're talking about retirement. I know. In retirement, do you have a vision for helping kids, maybe going back to school yourself, helping grandkids? This would be another way for you to build wealth and have it be tax-free as well. Lots of creative options. Do the tax planning work with your CFP, looking at all 6 areas of your financial life. Leverage these strategies for your situation. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.